Last week, crude oil prices jumped again after fresh tensions in the Middle East. Within days, petrol prices in Indian cities crept up too. At the same time, global rice prices touched a 5-year high after Vietnam restricted exports. So here's a question. When inflation rises in India, is it really about onions and rainfall? Or is it about something happening thousands of miles away? That's the news story of inflation in India. And it's why we need something called a Trade Exposure Inflation Index, or TEII. For decades, our inflation debates began and ended at home. If food prices went up, blame the monsoons. If inflation stayed stubborn, tweak the repo rate. But in the last few years, prices are being written not only in Nashik's fields or the RBI's corridors. They are being written in ports, shipping lanes, and commodity markets across the world. Think of 2022, when Indonesia suddenly banned palm oil exports. Within weeks, Indian households saw cooking oil prices rise, even though local supply was steady. Or the post-pandemic freight crisis, when container costs quintupled and electronics became costlier before they even reached our ports. Let's look at a few numbers. In December 2024, the headline inflation stood at 5.22% and food inflation at 8.39%. By April 2025, inflation fell to 3.16%, the lowest since 2019. And by July 2025, it eased further to about 1.55%, an 8-year low. That drop wasn't just an RBI success story. It also reflected softer global commodity prices. Meanwhile, the rupee depreciated by roughly 2.8% over 2024, and India still imports about 85 to 88% of its crude oil requirement. So every global price move and every currency twitch passes through to Indian costs. In short, inflation today is part local, part imported. Here's the challenge for policymakers. When inflation moves, they need to know why. Is it because domestic demand is heating up? Or is it because a harvest failed? Or because some imported inputs got costlier? Our usual indicators, CPI and core inflation, do not tell us that. They show the symptom, not the source. That's like a doctor knowing a patient has fever, but not knowing whether it's from a virus or from dehydration. This is exactly where the Trade Exposure Inflation Index comes in. Think of TEII as a magnifying glass that separates inflation into two piles: what's made at home and what's imported through global trade. It does this through three simple channels. First, imported consumer goods, things you and I buy directly from abroad, like smartphones, edible oils, or gold. Second, imported intermediate goods, items factory use to make other products like fertilizers, plastics, or pharmaceutical ingredients. And third, the exchange rate effect. When the rupee weakens, even a stable dollar price means a higher rupee cost. By combining these three channels and using the same CPI weights we already have, the TEII would tell us every month how much of inflation came from abroad. Imagine this. If inflation in a given month is 5% and TEII shows that 2% was trade exposed, then we know roughly 3% was homegrown. That simple number could change how we talk about inflation entirely. Now here's the good news. Building the Trade Exposure Inflation Index isn't difficult at all. Most of the data already exists inside our system. The Consumer Price Index itself is published every month by the Ministry of Statistics. The Directorate General of Commercial Intelligence and Statistics already maintains detailed import and export data broken down by product categories. The Reserve Bank of India tracks exchange rate movements and import-weighted price indices. So the inputs are sitting in our databases, we just need to connect them. Analysts could take CPI items, mark which ones are import sensitive using trade data, and use RBI's monthly exchange rate statistics for the currency effect. With that mapping in place, a monthly TEII could be computed with very little new data collection, just smarter use of what's already available. In other words, India doesn't need a new survey, just a new lens. Why does this matter? Because the right diagnosis leads to the right policy. If inflation is domestic from food supply or strong demand, then monetary tightening or supply management might help. But if inflation is imported, say from oil prices or a weaker rupee, raising interest rates won't fix it. We'd need trade, energy, or currency measures instead. The TEII would help policymakers and markets see that difference clearly. In today's interconnected world, no country can fully isolate itself from global price movements. But we can at least measure them and respond smarter. Inflation in India can no longer be explained only by the monsoon or the repo rate. Our prices are shaped by ships, supply chains, and exchange rates by the world itself. So it's time for India to build a trade exposure inflation index to understand not just how much prices moved, but where that movement came from. Because the world's prices are now India's prices. And the sooner we measure that truth, the better our policy will be.